Hims and Hers, the hypergrowth telehealth platform on a mission to make the world feel great through the power of better health, is on a tear lately, now up about 140% year to date, beating the general market by a wide margin. And now, Hims stock is trading within a few dollars from its all-time highs of $25 a share, so basically the stock has completely recovered after crashing nearly 90% from its peak, which is just incredible. However, the journey back to its all-time highs have not been a smooth one, as Hims dealt with multiple short reports and constant negative news. So there was a lot of doubt, fear, and uncertainty, but I think sentiment is starting to shift in favor of the bulls, especially after its Q3 earnings report, where Hims pretty much destroyed all expectations. So today I want to talk about Hims Q3 results and give you guys an update on the stock and what I think about the stock moving forward. As always, you can read the article version of this video, which I will leave the link in the description box below. And with that out of the way, let's take a look at Hims and Hers Q3 results. So looking at Q3 results, revenue came in at $402 million, which beat the high end of management's guidance by $22 million and analyst estimates by $19 million. So Hims continued its perfect track record of beating revenue estimates, which is good to see. But more importantly, growth accelerated by 25 percentage points from 52% growth in Q2 to 77% growth in Q3. So just when you thought growth will slow down, Hims just comes in defying gravity and destroying expectations. So never ever underestimate Hims. So growth was mainly driven by its growing subscriber base, which was 2 million in Q3, up by 44% year over year. And it's also worth noting that Hims added a record 183,000 subscribers in the quarter, so a lot more people are joining the platform. But most notably, the number of personalized subscribers grew by 175% year over year to a little over 1 million, which now represents more than 50% of the company's subscriber base for the first time ever. So what this means is that this reflects very strong demand for personalized solutions, medical care, which are basically medical treatments that are customized based on factors such as type of condition, dosage level, as well as form factor. So I think personalization is one of the company's key differentiating factors, so it's good to see strong growth in the number of personalized subscribers. In addition to its personalized solutions, subscriber growth was also driven by the company's new weight loss offering. For instance, its oral weight loss business has reached a $100 million annual revenue run rate 7 months after its launch and delivered more than 1,000 orders per day on average during the third quarter. And of course, there's the company's compounded GLP-1 injections, which contributed 4 percentage points to subscriber growth in the quarter, and this is expected given the shortages that we're seeing among branded GLP-1s such as Eli Lilly's Zepbound and Novo Nordisk Ozempic. But on a side note, outside of GLP-1s, subscriber growth remains strong at approximately 40% year-over-year growth. So while the shortage of branded GLP-1s serve as a catalyst for Hims and Hers, keep in mind that it is just a tiny component of the investment thesis. That being said, the growth of its weight loss offering drove higher monthly online revenue per subscriber, which contributed to higher revenue growth. So as you can see, monthly online revenue per subscriber grew 24% year over year to $67 per subscriber, which is a record high for the company, as you can see right here. So as more new and existing subscribers sign up for a weight loss subscription plan, we can expect the metric to continue to trend higher, because its oral weight loss business or offering starts at $69 per month, while its GLP-1 offering starts at $199 per month, which is much higher than the average $35 to $55 per month price tag for other product categories. So considering higher monthly online revenue per subscriber, strong subscriber growth, and the ramp of its weight loss offering, it's no surprise that management raised their guidance once again. But what surprised me was how much management raised that guidance. So as you can see, Management now expects revenue to be $470 million at the high end in Q4, which represents a 91% year-over-year growth in the quarter. And that is, an increase from its prior guidance of $426 million, which is just a 73% year-over-year growth. So that's a very huge bump in terms of the guidance that is raised by management. And we can see the same thing for full year 2024 revenue guidance, which is now $1.465 billion, up from previously $1.4 billion. So it is now expected to grow by 68% year-over-year growth in the whole of 2024, which is a raise from its prior guidance of just 61% year-over-year growth. And this is most probably due to the outsized growth of its weight loss offering. And even though the FDA has taken several branded GLP-1 drugs off the shortage list, such as Zepbound and Ozempic, management still sees that the shortage of available name brand GLP-1s in the US is not abating, with nearly 80,000 individuals that come to the Hims & Hers platform reporting that they have been unable to obtain branded GLP-1s and that they have seen the pace of these reports accelerating over time. Additionally, management hinted that Hims & Hers will continue to be able to sell their compounded GLP-1s regardless of the shortage status, and this is made possible through personalization. So in other words, the ongoing shortage and its ability to continue to sell compounded GLP-1s after the shortage will be a tailwind for Hims' business for the foreseeable future. And so expect robust growth ahead in 2025 and beyond. And besides, Hims & Hers has only 2 million subscribers in its platform currently, and with more than 100 million individuals suffering from obesity-related challenges and other conditions, Hims & Hers still has so much growth runway ahead. But even so, we have to understand that other areas of the business are growing very rapidly as well. For instance, the Hers brand is currently at an inflection point, growing at an accelerating trajectory. And Hers has more than 400,000 subscribers as of Q3, which is 25% of the subscriber base. And management continues to believe that it can surpass the size of the male brand, which is the Hims brand. In addition, Hims intends to expand its personalized offerings by introducing more form factors and multi-condition offerings in the coming months, which should support growth moving forward. So all in all, I believe Hims will continue to execute and Hims will continue to grow rapidly with or without GLP-1s. They have shown this time and time again, and I think this time is no different. Turning to profitability, Q3 gross profit was $318 million, up 70% year over year, and this represents a gross margin of 79%. And although gross margin is really high at 79%, we can see that gross margin have been declining over the last few quarters. Furthermore, management expects continued gross margin degradation in Q4, mainly due to the recent launch of its weight loss offering, which has lower margins given that it is still early in its life cycle. Nevertheless, I expect margins to continue to fall in the long term, probably to about 75% or below, since the company's main goal is to provide high-quality, affordable medical care for all. So I expect Hims to continue to pass on the savings to consumers in the form of lower prices, which means lower margins, gross margins in the long run. On a positive note, this should attract more subscribers into the platform, especially among lower income groups. As a matter of fact, lower income individuals already make up more than 25% of the company's subscriber base, or 400,000 subscribers, but I expect this group to continue to grow even more as Hims continue to lower prices. But despite driving prices down, Hims & Hers bottom line continues to improve, with operating income of $22 million in Q3, which represents a 6% operating margin, which expanded by 10 percentage points from last year and about 3 percentage points quarter over quarter. And as you can see, all expense lines as a percentage of revenue were down year over year, displaying strong operating leverage. And more importantly, HIMS continues to drive marketing leverage, with marketing expenses as a percentage of revenue dropping 6 percentage points year over year to 45%. As a result, net income improved to $76 million with EPS of 32 cents. However, this included a $61 million tax benefit, so excluding this benefit, net income would have been around 15 million, which is still a record high for the company, so that's good to see. Adjusted EBITDA also improved to another record high, which was $51 million in Q3, representing a 13% adjusted EBITDA margin, which expanded by about 8 percentage points year over year and 1 percentage point quarter over quarter. And also worth mentioning is that this beat the high end of management's guidance of $40 million. So again, really strong top line and bottom line performance led to management raising their adjusted EBITDA guidance as well to $55 million in Q4, which is up from $43 million previously. And for the full year, management now expects adjusted EBITDA of $178 million at the high end, up from $155 million previously. So this implies a 12% adjusted EBITDA margin for both periods, up from 11% previously. So management expects profits to continue to improve from here, which is what we like to see. And I think HIMS will continue to drive operating leverage as it continues to scale, as well as through its investments in AI and other technology. So this includes its EMR, or electronic medical record system, which leverages data to reduce and automate repetitive and administrative tasks for providers. And then we have MedMatch by HIMS and Hers, which leverages AI and machine learning to analyze millions of data points for providers to identify the most effective treatment for patients. And I believe MedMatch is the brain behind the personalization aspect of HIMS and Hers. And as we've discussed earlier, the personalized solutions are growing very rapidly. In addition, HIMS also recently launched Clever Routing, which is a new intelligent customer routing system that connects subscribers with the right professional, whether it is the HIMS and Hers care team, provider network, or customer service. That being said, as HIMS continues to invest in all these AI and technologies, and as more data, customers, and providers come into the platform, the HIMS and Hers platform will inevitably become more effective and efficient, allowing HIMS and Hers to deliver better, faster, and safer experiences for both providers and consumers. And this will not only lead to robust revenue growth, but also robust earnings growth for years to come. So looking at the company's balance sheet, HIMS and Hers has $243 million of net cash as of Q3 with virtually zero debt. And as you can see, the company's net cash balance continues to grow over the last few quarters, which is good to see. And that's because of record free cash flow in Q3, which was $79 million, growing 312% year over year, representing a 20% free cash flow margin, which is really strong. And with all this free cash flow coming into the business, HIMS bought back $30 million worth of its stock in Q3, and the company repurchased about 1.9 million shares at an average share price of about $15.81. So if you look at this chart, which I posted on X a few days ago, we can see that the share price dropped below $18 back in August, which is exactly when management initiated their buybacks. So management really bought the dip here, and I think it's just perfect timing. That being said, buybacks should help with dilution from stock-based compensation, and as of Q3, HIMS still has $70 million of buyback capacity left, so expect more buybacks ahead, especially if we see a huge dip in prices. Aside from that, management also used the free cash flow generated to acquire MediSource, which is now the company's first 503B compounding outsourcing facility registered with the FDA. So according to the 10Q filing, the purchase price was about $31 million, but more importantly, this facility has the capability to produce GLP-1s, so this acquisition will help the company ramp up volume and fulfill all those demand for its weight loss offerings. But above all, through its investment in the 503B facility, Hims and Hers is becoming a more and more vertically integrated telehealth platform, and this allows the company to scale with greater efficiency, control every aspect of the value chain, and drive more value for providers and consumers. Okay, let's now get into the interesting stuff, valuation. As it stands, the company trades at an EV to revenue multiple of just 3.9 times, and this is based on trailing 12-month revenue. If it was based on forward revenue, the multiple compresses even more to just 2.4 times. But however you look at it, I think this kind of multiple is extremely cheap for a company that is growing 50% plus, that has a gross margin profile of 80% plus, is already GAAP profitable, and is already free cash flow positive and has zero debt. But let me do a quick comparison with a very popular stock, and that is Palantir. As you know, Palantir stock is going crazy lately, up more than 200% this year alone. In a nutshell, Palantir's rally was driven by multiple factors, including accelerating revenue and customer growth due to the recent launch and success of its new platform, AIP, which is a game-changing platform for enterprises to apply AI into their daily operations. And Palantir's AI platform domination in this AI-hyped world gave it the title the Messi of AI. But let's compare Palantir with Hims and see what the hype is all about. So below here, you can see some key metrics for both companies. And as you can see, Palantir's growth over the last 3 years was 23% per year, while Hims' growth was 76% per year for the last 3 years. Over the next 2 years, analysts estimate that Palantir will grow 22% per year, while they expect Hims to grow more than double that rate at 46% per year for the next 2 years. In terms of profitability, both companies have virtually the same gross margin profile at about 80%. But what's different is that Hims has a lower operating margin of just 1% compared to Palantir's 11%, and free cash flow margin of 9% for Hims and 28% for Palantir. But keep in mind that Hims' operating margin and free cash flow margins are improving rapidly, with operating margins of 6% and free cash flow margin of 20% in the latest quarter, as I've mentioned earlier. So just by looking at these metrics, Hims doesn't seem too far off from Palantir. Hims is definitely less profitable, but the company is growing at least 2 times faster than Palantir. However, just look at the difference in terms of valuation. As it stands, Palantir trades at a forward EV to revenue multiple of 37 times, while Hims and Hers is trading at only 2.4 times. In other words, Hims is trading 15 times cheaper than Palantir, despite Hims and Hers growing more than 2 times faster than Palantir. And yes, this is not an apples to apples comparison. There's a big difference in terms of quality. Palantir has arguably the most important, the most powerful AI software in the planet, while Hims is merely a hyper-growth telehealth company prone to the threats of competition and regulation. And that is why there's a huge valuation gap, as you can see right here, between the two companies. And yes, Palantir's fundamentals are better than Hims and Hers, that's for sure, but I think it's not too big of a difference that justifies Palantir trading or being valued at more than 15 times than Hims and Hers. And if Palantir can be called the Messi of AI based on these fundamentals, then I think Hims deserves to be called the Messi of Telehealth. And I know it sounds ridiculous, but given Hims and Hers' incredible performance over the last few years, its improving fundamentals and its growing moats, I think Hims and Hers deserves to be called the Messi of Telehealth. The problem is that Hims is not being valued like it's the Messi of Telehealth. I mean, if Palantir can trade at a 37 times multiple, then I think Hims and Hers should trade much higher than its current multiple of 2.4 times. I'm not saying it should trade at 20, 30, or 40x. I'm saying it deserves a much higher multiple given its fundamentals. So what would be an appropriate multiple for Hims and Hers? Well, I think that's subjective, but I think a multiple of 5 to 10x is already good enough. That being said, I think both companies will continue to do well. They will continue to dominate and grow. But if you ask me which stock will do better from here, I'd have to pick the Messi of Telehealth without any hesitation. Okay, Palantir aside, I'm raising my price target for Him stock from $33 a share in my previous video to $45 a share, mainly due to higher expected growth rates and free cash flow margins. So this is my 12-month base case price target, and this represents a 95% upside potential based on the current price of $23 a share. So despite being up more than 100% year to date, I believe there's so much more upside for Hims and Hers stock. And this is why I continue to hold Hims stock and not selling a single share. In fact, I plan to add more into my position if we see a major dip in the share price. So wrapping up this video, following its excellent Q3 results, I am more convinced than ever that there's a fundamental shift in the healthcare industry where telehealth technology and AI will drive immense value for all stakeholders in the industry, including consumers, providers, vendors, and even shareholders. And I believe Hims and Hers is at the forefront of this fundamental shift. And by definition, Hims and Hers is the Messi of telehealth. It has the brand, it has the network, it has the technology, the formula, and the vision. Yes, there's uncertainty in terms of the GLP-1 shortage and how the regulatory landscape will evolve and how it will affect Hims and Hers sales of GLP-1 compounds. And maybe that's why valuation remains depressed, because there's so much fear, uncertainty, and doubt that is baked into the stock currently. However, it's important to note that GLP-1s was never a part of the investment thesis, and as management highlighted, the GLP-1s, the subscriber growth outside of GLP-1s remained strong at about 40% year-over-year growth in Q3. So the investment thesis outside of GLP-1s remains firmly intact. And given its strong fundamentals, strong performance, and strong outlook, I think the Messi of Telehealth is undeservedly undervalued, and I think it deserves a much higher valuation from here. That being said, thank you guys so much for watching this video. If you enjoyed this video, please hit like and subscribe for more investment content like this. As always, I appreciate you and I hope you have an amazing day. See you guys in the next video.